My name is Jeffrey Kennedy, and welcome to Trader's Classroom. One of the reasons I'm so passionate about technical analysis is its flexibility. And what I mean by that is it's applicable across all markets, but more importantly, it's also applicable across all time frames. What we learn about in Trader's Classroom each and every day, the Elliott wave technique, indicators and oscillators, chart patterns, they're also applicable, or they also work equally well on the intraday chart level, even all the way down to, say, the 5-minute, 10-minute, 1-minute price charts. And that's what we're going to be discussing in today's episode. So let's begin. Now, the price chart you're in front of you, you're looking at is a commodity, and I typically don't cover the commodities in Trader's Classroom because of the sister publication that I also edit, Commodity Junctures. But I did receive a question in today's update that I would like to actually discuss. And so, for the question, thank you, Josh.
Hello, Jeff. This is Farmer Josh from Kansas. I recently sent you an email asking a couple questions, and I really appreciate you responding to that email. I've got another question this evening. It's on the October live cattle. The high that was made back on June the 6th, starting at that point, I'm counting this wave being basically 5 waves down, ending on the August 26th at 139.65, which is the most recent low, with a B, C counter trend that's happened in the last 4, 5, 6, 7, 8, 9, 10 days. My question is, am I counting those waves on this chart correct? Keep up the good work. Thank you.
Okay, well, that was the question posed by Josh, and what I thought I would do initially prior to today's lesson in Trader's Classroom is go ahead and discuss the point he brought up. Now, this is the interpretation that I'm currently utilizing in live cattle for commodity junctures. I'm utilizing a 1 wave count, expanded flat wave 2, small truncation. Here's wave 3, 4. And then now I'm looking for a final move to the downside. This is my 5th wave move, and within wave 5, I've identified waves 1, 2, 3, 4, and 5. Now, the interpretation that Josh presented or suggested was this wave count right here. Simply, pretty much the same thing. Waves 1, expanded flat 2, 3, still the 4, but go ahead and identify all of wave 5 of 1 complete here. Now, is this correct? Well, that's up for debate. We could go ahead and identify the structure as complete right now, but there are essentially 2 reasons why this would not be my lead interpretation. Well, first and foremost, price action up off the low thus far has yet to trace out an impulsive advance. In other words, we're not seeing a 5-wave rally. We're seeing price action which is more corrective in nature. Of course, you can see this is a sideways price affair. Also, too, another problem I have with this interpretation is that if we look at the beginning of the price move, it's fairly evident that you do indeed have a 1 here and a 2 up. So 1, 2, 3, 4, 5 for 1, 2, and then a clean wave 3. So really, I think the best interpretation within the current decline would be to go ahead and identify this as wave 1, subsequent advance as wave 2, this entire move here as wave 3. Now, it is possible that we may have done, say, a 4 advance here, in which case we would go ahead and identify this move as wave 5. That's a possibility. Move the 1 over. Now, if that is indeed the case, most likely the subsequent price action so far, since this is an initial 3-wave rise and that's a 3-wave decline, then I would be anticipating live cattle to actually push up a bit here in waves A, B, and C of a flat second wave. And that would actually fit with the larger idea that we're working here. But going back to Josh's question, is there anything wrong with this interpretation? Well, overall, I don't believe so. You're certainly going in the right direction, and I applaud you on your effort and your interpretation. But whenever you come up or whenever you start with an initial wave count to the downside or to the upside, number one, make sure that the subdivisions are indeed there. So you have waves 1, 2, 3, 4, and 5. But you also need to look a little bit more closely. And I think if you look a little bit more closely at the wave count proposed, you'll see that the move to the downside from this extreme to what you were originally proposing as the end of the move here as a completed structure. Well, the problem with this interpretation, more simply put, would be that the sell-off, your wave 5 sell-off, really consists of only 3 waves. We need a fourth wave move to actually balance out the larger count. Also, too, if we take a look at another interpretation I'm currently working in live cattle, you can see that we have this interpretation as well, where we have a series of 1s and 2s to the downside. Now, the reason this is not my lead interpretation is because we don't have the confirmation. As I say quite frequently in Trader's Classroom as well as in commodity junctures, the only thing that can confirm an Elliott wave count is price action. And as of yet, we don't have the price action we need to the downside to comfortably embrace the idea of a wave 3 of 3 sell-off. This is where we would most likely see, say, an acceleration gap to the downside or some type of breakaway gap, that big volatile price move. But I guess this actually touches on another important aspect of the wave principle, but one that many individuals actually criticize, but I actually find very, very valuable for myself, certainly from a trading perspective. If we look at the price action on live cattle, we have this as a possible wave count, 1, 2, 1, 2 to the downside. We have the lead interpretation, or what I'm currently working with in live cattle, which is this interpretation, 1 expanded flat, 2, 3, zigzag 4, nice alternation between 4 and 2, working the fifth wave move to the downside. And then we have the interpretation as proposed by Josh. Okay, bottom line, even if you look at these interpretations, and they're all different, but more importantly, they're all impulsive. They're all impulsive declines. We're not looking at this as, say, 1, 2, 3, 4, 5 to the downside and then ABC to the downside or WXY. We have a clear idea that prices are indeed unfolding in an impulsive manner. So from a trading perspective, my attention is to the downside, and therefore I'm going to be looking for these opportunities for these counter trend moves as my selling opportunities or my opportunities to rejoin the larger downtrend. So Josh, I hope that answers your question, and thank you again for the voicemail participation. Now on with today's lesson. Now if we go back and take a look at, or we'll go back and what I was originally discussing, one of the things I find so valuable about technical analysis is its flexibility. We can utilize it. I can apply it on the bond market equally as effective as I do on the euro, which I can equally as effective on intraday stocks. It doesn't matter. Any market, any time frame, and that's a very powerful tool. For example, everybody is familiar by now, I hope, of the head and shoulders formation, which was popularized by Edwards McKee in their wonderful book, Stock Analysis, Technical Analysis of Stock Trends. And here is just a basic pattern. This is actually a head and half shoulder formation, a formation I've written about before in commodity junctures, where we have the left shoulder here, here's the head, here's the right shoulder. I call this actually a half shoulder because it only goes to the midpoint of the channel created by the height of the actual left shoulder here. And then we see we have the neckline between these two extremes here. Again, a textbook example of a head and half shoulder formation. Penetration of the neckline here then argues for a move equal to the height of the head to the neckline measured down. This is a daily chart level of Solar City, and notice the whole formation took a number of months to actually develop or form. Well, here's a price chart here that I'd like to show you as well, and equally exciting. This is a 5-minute price chart of Netflix. A 5-minute price chart of Netflix, but the overall formation is still the same. Here we have a low here that I'm identifying as a left shoulder. Here we have the head. We advance. That allows us to then identify and draw a neckline in this market. Then we have the pullback here. This is our right shoulder. Once we break the neckline, we then move up to the neckline measurement, which you can clearly see we exceeded. Now remember, the neckline measurement, as I've discussed before, that typically represents only a minimum objective. So here's a great example of a head and shoulder formation on the daily chart level. And here's an excellent example of a head and shoulder formation. This is a bullish reversal, or the inverted head and shoulder formation, on the 5-minute price chart in Netflix. Now let's take a look at another example. And let me bring over a different price chart. This is actually going to be Amazon. And what we're looking at here really is this price action right there. This is what is referred to as a double bottom. And the reason why is because prices come down to a specific level, advance, and then they come back down, hit it again, hence your double bottom. Well, notice the intervening high between the left low and the right low. That's resistance. Okay, why is it resistance? Because prices moved up to that level and then reversed. Okay, well, if you draw simply another horizontal trend line here, look what happened. That resistance, once penetrated, then acted as support for the subsequent price move we saw on Amazon. This is where, in this price chart, this is a two-day per bar price chart, meaning that each individual price bar you see actually represents 2 days worth of price action. This formation took many, many months to actually form. But notice the tendency, the double bottom. Here's resistance, then resistance acting as support. Well, let's go to Ambarella, 5-minute chart level. Well, here's our double bottom. We put it in the other day here, actually on a Friday. We come down, form a low, advance, come back down. Here's our double bottom. Break through it in Monday's trading, come right back down to the extremes that occurred between the left low and the right low. That was our resistance. Now resistance is acting as support, and we all now know the importance of that because I talk about that frequently in Traders Classroom as well as in commodity junctures. One of the easiest ways to identify a significant trend change in a stock or commodity or bond or index or ETF is to look for those phase changes, those transition points. You're looking for those points where resistance becomes support and or support becomes resistance. Now let's look at another chart pattern. And of course, we're all familiar with the Kennedy accumulation or Kennedy distribution wedge. This was a chart pattern we began discussing last year, and we essentially formalized this year in Traders Classroom. And thank you again for everybody participating in actually naming the formation here. Now, what makes the accumulation wedge different than what you would normally see in really any book on technical analysis is the double layer resistance band. Okay, now if we didn't have the double layered resistance band, it would simply be a barrier triangle or a rising wedge. It would certainly fit the description of many of the traditional chart patterns, but what makes it unique is the double layering on top. So this is the accumulation wedge, and we started working with this again last year, working with the CME group. And as you can see, we have the rising upward sloping trend line, the double layer of resistance. This is a classic accumulation wedge. Well, let's look at another possible pattern here where it does appear that we're working an accumulation wedge, and this would be in the IWM. This is the iShares. This is the ETF of the Russell 2000. And I remember not too long ago, this was a question, another question I received in the voicemail feature that we're experimenting with. Does technical analysis work, or does the Way principle work with ETFs? Absolutely it does, and here's a great example. This appears to be an accumulation wedge. Now, it's unconfirmed as of yet. We're still under the double layer of resistance, and here's our double layer of resistance. We have one extreme, we have another extreme, we have a rising upward sloping trend line. So what I'm going to be looking for moving forward, it would be a move or continued strength. And then, of course, we're going to be looking for that phase change, that transition point. We're going to be looking for resistance to then act as support as we see ideally further advance. So just wanted to point that out. And one more thing I wanted to point out, I don't have any charts to offer in today's PDF of Traders Classroom, but I was kind of taking a peek at the euro. Just wanted to just briefly mention that. And going back to the euro, the price charts you'll see next were ones that I presented in Traders Classroom not too long ago. And we were discussing the recent consolidation. We identified it as a WXY. The move to the upside contained within parallel lines. And then we were looking specifically at the intraday price action. We discussed this a little bit. And we worked with waves 1, 2, 3, 4. This was our wave Y move, A up, B down, flat correction. Here's our big move up in wave C. And then I just kind of wanted to update everybody where it looked to me like where we might be. This is what we were anticipating. Move down, followed by a 2 up. Well, since that's kind of what we were looking at, and that's kind of what price action has done, I would probably just go ahead and put the 5 of 1 right here. And probably just go ahead and put that wave 2 right here. Now this is just a thought, it's unconfirmed as of yet, but it is interesting because again, if we go back to the rules and guidelines of the wave principle, what do we know about the depth of the corrective waves? The guideline regarding the depth of corrective waves. Whenever you have a 5-wave move complete, a retracement occurs that pushes prices back into the span of travel of the prior 4th wave, most often ending near its terminus. Well, look where we went. And also 2, I'd probably identify this as a flat correction, 3 up, 3 down, and then our C, nice C, 1, 2, 3, 4, 5. Now typically within a flat pattern, we like to see wave B end at or near the origin of wave A. Typically by 90%, a bare minimum is 80%. This doesn't fit the 80% rule. So that being the case, we do need to go ahead and just for safety's sake, go ahead and put our corrective price channel up. We have moved above that, but we weren't able to sustain the move. So moving forward, just keep a close eye on the euro because I think this is a good count. Certainly, if it is indeed correct, it's going to bring in a lot of possibilities over the next week or so. But just a thought. I just wanted to share that thought with you. That about does it for today. Thank you again, Josh, for your question, and thank you for participating in this voicemail experiment. That about does it. I'll see you not tomorrow, but I'll see you Thursday for a Traders Classroom live event.